Here is something that sounds completely made up, but I promise you it is real. In Australia, there is a way to own shares, collect the dividends, and actually get a check back from the tax office at the end of the year. Not just a smaller tax bill, an actual refund, cash from the ATO for owning shares. It is called a franking credit, and it is one of the most generous and honestly most misunderstood perks in the entire Australian tax system. Most people either have never heard of it or their eyes glaze over the second it comes up. So today, no fluff. Let us actually make sense of it, and while we are at it, sort out exactly how dividends get taxed in this country, because it is a lot friendlier than you probably think. Right, let us start with the star of the show, franking credits, because once this clicks, the rest is easy. Here is the deal. When an Australian company makes a profit, it pays company tax on that profit before it hands any of it to you as a dividend. The government worked out, fair enough, that it is a bit rough to tax that same money twice, once in the company's hands and again in yours. So they came up with imputation, which is a fancy word for this. When you get a franked dividend, it comes with a credit attached for the tax the company already paid. That credit is the franking credit. Now here is where it gets good and where Australia is genuinely unusual. You add that franking credit onto your dividend to work out your income, you pay tax at your own rate, and then you subtract the franking credit from your bill. So if your tax rate is lower than the company tax rate, the credit is bigger than the tax you owe, and the ATO refunds you the difference. That is right, you can get money back. If your tax rate is higher than the company rate, you just top up the difference, which is far less than being taxed on the whole lot. Either way, you are not getting taxed twice. For a retiree or anyone on a low tax rate living off fully franked Aussie shares, this can mean a genuinely juicy refund every year just for being a shareholder. Let me make it real with a quick example. Say a company pays you a $70 fully franked dividend. Tacked onto it is a $30 franking credit because the company already paid $30 of tax on that $100 of profit. So the tax office treats you as having earned the full 100. You pay tax on that 100 at your own rate, then knock off the 30 that has already been paid. If your rate works out to less than $30, the difference lands back in your pocket as a refund. If it is more, you just cover the gap. Neat, right? And in practice, the big established Aussie companies, your major banks and miners and the like, tend to pay fully franked dividends because they pay full Australian company tax. Good news too, if you hold Aussie shares through an ETF, those franking credits generally get passed straight through to you as well. So let me put that into plain numbers. Say a company pays you a fully franked dividend. Tacked onto it is a credit for the tax the company already handed over. If you are a low earner, that credit can wipe out your tax on the dividend entirely and still leave some over, which comes back to you as a refund. If you are a top earner, that same credit covers a big chunk of your bill and you just pay the gap. This is why so many Australians love fully franked dividend shares. It is one of the few places the tax system genuinely works in the little guy's favour. Just keep in mind, not every dividend is fully franked. Some are only partly franked or unfranked, especially from companies that have not paid full Aussie company tax, like a lot of international earnings, and those come with a smaller credit or none at all. And one quick heads up so you do not get caught out. To actually claim franking credits, you generally need to have held the shares for at least 45 days. It is a rule designed to reward genuine investors, not people ducking in and out just to grab a dividend. So it is another nudge toward buying and holding. Okay, dividends sorted. Let us quickly deal with the other bits of investment income so you have got the full picture. Foreign dividends, like from US shares, do not get Aussie franking credits because no Australian company tax was paid on them. They get added to your income and taxed at your normal rate. Though if a foreign government already took some tax, you can usually claim an offset for that so you are not double taxed. Interest from savings and the like is the least exciting. It just gets taxed at your full marginal rate, no discount. And capital gains, the profit when you sell, get a cracking break. If you have held the investment longer than 12 months, you generally only pay tax on half the gain. Hold for over a year, halve the taxable gain. That 12-month mark is one of the most valuable dates in Aussie investing, so it is worth remembering. Now, it would not be a Cooper video if I did not give you the flip side, so let us talk about where it bites. Franking credits are lovely, but dividends and gains still get added on top of your salary. So if you are already a high earner, that extra investment income can get taxed at your top marginal rate. which with the Medicare levy climbs toward 47%. On top of that, there is the Medicare levy surcharge, an extra whack if you earn above a certain amount and do not hold private hospital cover, which catches a surprising number of people off guard. And for the real high earners, there is Division 293, where the tax on your super contributions effectively doubles once your income gets high enough. So the more you earn, the more the ATO leans in, and the more it pays to be smart about where your investments sit. Which brings us to the fix, and this is where it all ties together. The most powerful lever most Aussies have is super. Inside super, investment earnings are taxed at just 15% while you're working. But here is the kicker that connects right back to franking credits. Once you are retired and your super is in what is called pension phase, the tax rate can drop to zero. And when you are on zero tax and you are holding fully franked shares, those franking credits have nothing to offset, so they get refunded to you in cash. That is why franked Australian shares held inside super in retirement are such a beloved combo. It is about as tax-friendly as it gets in this country. Picture a retired couple with their super in pension phase, living off a portfolio of fully franked Aussie shares. They are sitting on zero tax, so every one of those franking credits has nothing to cancel out and the whole lot gets refunded to them in cash each year. That is a genuine income stream, part of it effectively funded by the tax office. Not a bad way to spend your 60s. Outside of super, the game is asset location, just putting the right investment in the right place. Hold your franked Aussie shares to make the most of those credits. Use that 12-month capital gains discount wherever you can. And remember that super is doing a lot of quiet, heavy lifting at a low tax rate in the background. One more handy tool while we are here. A lot of companies offer a dividend reinvestment plan, or a DRP, where instead of taking the cash, your dividends automatically buy you more shares, usually with no brokerage. It is a dead simple way to let compounding quietly do its thing without you lifting a finger. And of course, Australia does not have a tax-free investing account like some countries do, so super really is your main shelter here. So let me tie a bow on it. In Australia, dividends are taxed more kindly than a lot of people fear, mostly thanks to franking credits, which stop you being taxed twice and can even land your refund if your rate is low. Foreign dividends and interest are taxed at your normal rate, and capital gains get halved if you hold longer than 12 months. The pain shows up when investment income stacks on top of a big salary, so watch out for the Medicare levy surcharge and, for high earners, Division 293. And the smartest move for most people is to lean on super, especially in retirement. Hold your franked shares to grab those credits and use the 12-month discount. Just remember these rules shift around, so check the current numbers before you rely on any of it. Righto, that is franking credits and dividend tax. Hopefully a good deal clearer and maybe a bit more exciting than you expected. Because a refund from the tax office is a rare and beautiful thing. And now you actually know how to get one. Give this a like if it made franking credits finally make sense. Subscribe if you want the rest of your money sorted without the jargon. And if you are holding shares, take 2 minutes to check whether your dividends are actually franked. You might be leaving free credits on the table. Catch you next time.